pressure.
What can you do to protect your portfolio in the days ahead? We're not even talking about growing it at the moment, although we will with our next two guests.
It's all about being defensive, folks. Keith Springer, president at Capital Financial Advisory, is with us. And, you know, Keith, that is the big question right now.
This is Mark Pato.
I mean, Mark, I'm sorry. Mark
Pato, as well as Chief U.S. Market Strategist at Cantor Fitzgerald.
Yeah, sorry. That's the big question right now, is that you've got so many people that are just sitting in cash. They're bragging that they've got their money in T-bills. When does that money come back into the market?
Well, that money that you're talking about, a lot of the retail money, is probably going to wait until they're proven that the markets have turned the corner. So they're always a little bit late to the party, and they're also the last ones to get out with the retail money. It's really that a lot of the funds have put a lot of money in cash because they're worried about redemptions. And that money is probably going to be a bit more reactive as soon as we start to see something more positive happen. And I think that has started to happen already. And once we get past October and we start focusing on the holidays, right now everybody's lowering the bar, right? It's October, all the companies are coming out with their earnings. They want that bar so they can just step over it. They want to beat the fourth quarter numbers because everybody wants to finish on a positive note. So that's the key here.
Let's bring in Keith Springer. Keith, you have talked extensively about the fact that things look pretty dismal right now. Eventually, I'm sure you believe that they will come back. But how do you position a portfolio in this typical time?
Well, you've got to be careful on this because what we're due for is a rally. The market is an excellent predictor of the future economy and what's about to happen. And it's telling us that something is about to happen that we're not prepared for, that we weren't warned about. I do expect a big rally. Typically, we always get a big rally. Even in 1929, we had the initial drop, a big rally, and then it fell back again. There are some great opportunities, some dividend-paying stocks. Some of the corporate bonds are fantastic. Some of the 3, 4, 5-year corporate bonds are available. Some of the banks, which have taken the risk out of them from the Fed. So there's some tremendous opportunities out there. But you do have to be careful. If you're going to play this rally, you have to be prepared to get in and then get out. Longer term, look for dividends, look for income.
You know, Mark, I mean, it is about the word recession. Whether we're technically in one or not, the debate is off the table at this point. It's a severe downturn. It's a recession. How do you invest in a recession? And if we are in one, how long does it last?
Well, Keith made the point that when the market actually anticipates what the economy is going to do. So the market has already told us that we're going into a recession. So we're through most of the worst of it. There might be a spike down somewhere along the way, but the market has already told us that a recession is coming. You're in defensive stocks, that's consumer staples and a lot of the defensive areas that you see, typically tobacco, soda, things like that, Coke. Those are the types of companies that people put a core position in. But I think that we can start to get a little bit more aggressive and look for a better fourth quarter. As Keith said, trade a little bit, maybe do tech and retail for that fourth quarter.
Keith, I want to go back to what you said about dividend plays. How can you get the guarantee from the company that the dividend will last? That's the thing. A lot of people are saying, oh, go for the companies that pay out the dividend, but who's to say that they won't chop off the dividend?
Well, it's very possible, and that's what I was trying to say, is you want to be in the right sectors.
Sure.
You've got to be very careful because basically what the economy is telling us and what the market is telling us is it knows we're going into a recession, but it's predicting much more than a recession. So I'm going to urge everyone to be much more careful. The dividend plays you want to be with are in the sectors that are going to be resilient, maybe healthcare. I particularly like healthcare properties, which is a real estate investment trust that deals in senior aging care and properties like that. That's where the money will be made. The population is aging. Those are going to be safer long term than, say, some of the manufacturing. As I said a few minutes ago, some of the bonds are fantastic. You can pick up 3, 4-year bonds and get 8, 9%. Those are almost stock market returns with not nearly the risk, so you've got to be careful. For the rally, you don't want to be in defensive stocks because those are going to lag on the way up.
Hey,
For the rally, which could be significant, you want strong growth stocks.
Well, Keith, I mean, what do you like in particular? I mean, is it the Qs, is it spiders, ETFs? Is that a better way to kind of go right now, is to do the indexes, diversify as much as you can instead of trying to be the stock picker right now?
Well, I think that's the important part. Remember, with the rally you're looking for instance, in 1929, the stock market fell 48% in the first month, then rallied 48%, so it had a great big rally ahead of it. For the rally, which could be significant, I love the Qs. I think the growth sectors are going to take off. I like the Russell 2000. I think the smaller cap stuff's going to do a little bit better. You know, I think those are the sectors you play. I think you stay out of the defensive sectors in the economy because they went down the least in this last downturn, but they will go up the least. And if you're going to be in taking the risk, you want to get the return. So it's very important to be in the right sectors. I love the Qs, love Russell 2000, but a lot of the sectors are going to do well. To stay out of the staples for the rally, but be careful because when it pulls back, it's going to pull back very sharply.
Let me go to Mark now. You say that you think that technology and retail might be decent plays through the end of the year. How can you say that? All I hear are people saying, I am cutting back on any kind of retail purchases that I'm making. And technology, at some point, these are going to look like discretionary pieces of equipment that people can live without. They'll go a couple of generations and they'll hang on to their old laptop that the kids spilled juice in because they can figure that they just don't have the money right now.
Well, it's all about expectations. And as you just said, everybody's expectation is so low. They've cut these stocks by 40, 50, 60%. So a lot of these stocks, if you're looking at the stock play, we're talking about beating expectations. If expectations are that it's going to be a horrible holiday season and we do something that's just a mildly bad holiday season, that's going to be great for stocks and it's going to be great for tech. And I think that there's a good play between now and the end of the year, maybe into early January, for those stocks. But again, we're talking about a relatively short-term trend.
Do you like consumer tech? Do you like business
consumer tech,
intelligence,
exactly.
that kind of thing?
It's more the consumer tech. Unfortunately, because of what's happened with the credit markets especially, I think that a lot of that business spending, like you're talking about,
CapEx.
they can make the CapEx, they can go that little extra year without doing it until next year.
I'm going to go back on my word with Keith really quick. I asked you not to be a stock picker, but I'm thinking of the discount names like Walmart and Target, who many analysts say will benefit from slower spending and people cutting back this holiday season.
Yeah, they definitely will. But again, to reiterate, when you're looking for the bump from the rally, you want to be in sectors that are going to grow. I agree. I think some retail will do well. But again, I think there's going to be much more of a disappointment down the road because I think the severity of the downturn is going to be worse than we expect. Walmart, Target will do well, but I consider them almost like a defensive type of stock. One sector I didn't mention yet is the banks. The XLF ETF, probably a great buy for a rally. Every time we have a little short-term pop like we've had today, the banks do particularly well. And I would imagine once we start to rally, the banks should really take off. It's the next downturn where they get hurt again. So XLF would be a great way to play it. Retail is going to be a little iffy. Yeah, the market is expecting a lousy Christmas, and they might have a rally because they've been hurt so much. But you've got to be careful because consumer spending is not going to pick up. Baby boomers are retiring. Demographics are changing. They're becoming net savers, not net spenders. So it's going to hurt more than we are expecting down the turn.
All right, Keith Springer, Mark Pato, our pleasure to have you. Thank you
guys
so much for your perspective.
All right, guys, how about double the investment advice for free?
We are going to have the Murray brothers with their...